Hi, my name is Casey Johansen, and I am a financial advisor over at Hammer Financial Group. I wanted to take a few minutes in light of recent market volatility to explain a little bit about how our investment planning philosophy, the bucket plan, helps minimize our financial clients' risk throughout their retirement, especially in times of market volatility. So before I go into too much detail about the bucket plan and how it works and why it works, I want to start with explaining to you about the money cycle. So there's three phases or stages of the money cycle. There's the accumulation stage, the preservation stage, and the distribution stage. The accumulation stage is pretty self-explanatory. You're still in the accumulation phase, you're still working, you're collecting a paycheck, and you're saving as much as you can into those qualified retirement plans like 401ks or IRAs. The key is you're adding to those plans, you're making contributions. So market volatility doesn't affect you nearly as much as the distribution stage. The distribution stage obviously is the exact opposite. It's now you're in retirement. You're no longer collecting a paycheck from work. You're no longer contributing to those retirement accounts. In fact, you're likely withdrawing from those retirement accounts to supplement the other income that you might have in retirement, like Social Security income and pension income. So obviously, no longer contributing, no longer dollar cost averaging. When you're withdrawing from those retirement accounts, market volatility plays a much, much bigger role and impact in your overall retirement portfolio. But there's that preservation stage that I kind of skipped over. Well, that's in fact one of the biggest things that we see people do wrong as they head into retirement. They go directly from the accumulation stage right into the distribution stage, and they do not set up a proper preservation stage in the money cycle, right? They go directly from accumulation into distribution. They don't change the way that they invest those dollars, and it ends up creating a lot of risk that we call sequence of returns risk. Okay, so it's really critical in making sure you have that preservation stage set up for what we call the retirement red zone, which is 10 years before and 10 years after your retirement date. So the biggest risk that you subject yourself to if you do that, if you go directly from the accumulation stage right into the distribution stage without changing the way your investments are structured or placed, you subject yourself to what we call sequence of returns risk. And this is just an example. It's a pretty generic, simple example of how impactful sequence of returns risk can actually be throughout your retirement. So as you can see here, we have an example with two different clients, for lack of a better term here. We have Mr. Johnson in orange, and we have Miss Hamilton in blue. And they do everything the exact same way. They have the same amount of initial investments, $100,000 each. They have those accounts allocated the exact same way as well. They have 60% of the account in stock. They have 40% of the account in bond. And they're each taking out an $8,000 per year withdrawal from those retirement accounts. The only thing that they did different is they retired 10 years apart. Mr. Johnson in orange retired in 1969. Miss Hamilton in blue retired 10 years later in 1979. And if we look all the way down to the bottom of the screen here, we can see Mr. Johnson actually averaged a higher rate of return than Miss Hamilton did. Mr. Johnson in orange averaged 11.78%. Miss Hamilton in blue, over a 30-year period, averaged a little bit less, 11.2. So conceptually, you would imagine that Mr. Johnson should be better off at the end of that 30-year period. But in fact, he's not. If we look here at the year-end value of Mr. Johnson's account, remember they each started with the exact same amount of money and distributed the same on a per year basis throughout their retirement. So if we look here, the year-end account value, we see Mr. Johnson actually runs out of money prior to that 30-year period. He runs out of money when he's 89 years old. Whereas Miss Hamilton in blue, not only does she not run out of money in that investment account, she actually passes away at the end of that 30-year period with over 8 times what she started with. Now, conceptually, how does that work? Mr. Johnson's investments averaged a higher rate of return. Why doesn't he have more at the end of time than Miss Hamilton? Well, the answer is the order in which those returns came. That played a huge impact here, the sequence of those returns. Mr. Johnson in orange had what we call a negative sequence of returns. He had a lot of down years in the market, especially early on in his retirement. You can see he had a negative market year right off the bat in year 1, year 5, year 6, and year 9. Now, most people know Rule 101 of investing in the stock market is never take money out when your accounts are down, right? Because what you're doing is if you take a withdrawal from an account that's down, you're taking that money out. You're not leaving it in there for that, so that when the market does recover, your money's able to recover along with it. That money's gone. It can never recover at that point once you liquidate those investments and take that withdrawal. The problem is in retirement, most people don't have that luxury to just say, I'm not going to take a withdrawal this year because the market's down. You know, you have to supplement your income to satisfy your lifestyle need in retirement, right? So that's the case for Mr. Johnson. He had a lot of negative years early on in his retirement, and a lot of the strong rates of returns came in the middle and towards the end of that 30-year period, which obviously helped increase his average rate of return over that 30-year period. But when you look at the year-end account value, it did nothing for him. He ended up depleting the account to a degree that could not sustain that $8,000 per year withdrawal throughout the entire 30-year period. Miss Hamilton is the exact opposite. She had what we consider a positive sequence of returns. You see, she had strong returns early on in her retirement, was able to build up an account value, and when she experienced the negative returns in the middle and later on in her retirement, she had built up an account value that could easily sustain that $8,000 per year withdrawal. And that's what you ultimately end up seeing here, with her ending with over 8 times what she started with, and Mr. Johnson passing away with no money, actually running out of money prior to that 30-year period. Again, even though the average rate of return was better on Mr. Johnson's portfolio than it was on Miss Hamilton's portfolio. And that's just, again, the years that they retired. We have the historical market returns here that's illustrated. So again, Rule 101 of the stock market is don't take money out when your accounts are down. You don't have that luxury, but you also don't want to be subject to this sequence of returns risk, right? I always say average rates of return are very deceptive. We educate on something that we call the new math here at Hammer Financial Group. And it just goes to show you exactly how misleading average rates of return can be, especially in retirement when you're taking withdrawals. So the new math, when does minus 30 plus 43 equal 0? And you're probably looking at me like I'm crazy, right? It never equals 0 unless you're talking about an investment account. So if I have a $100,000 initial investment, and let's just say I have that in a mutual fund portfolio. If I have $100,000 in my mutual fund portfolio, and in the first year, that mutual fund loses 30%. Well, I lost 30% on $100,000. At the end of that first year, my account balance is down to $70,000. So in year 2, to be able to get me back to even, right, get my portfolio balance back to that initial $100,000 value, I have to make a lot more than 30% rate of return in year 2. Remember, because I'm based off of a $70,000 account value starting in year 2. So I actually have to make 43% in year 2 to get me back to my initial investment of $100,000. So over that 2-year period, my account lost 30%, made 43%, and I'm back to even. But if you look at the mutual fund statement that they publish for you on your annual statement, if they show a 2-year average rate of return, they're going to tell you average 6.5% rate of return over that 2-year period, because they're going to take the 43% up year, subtract the 30% down year, and divide it by the 2-year period that you held that investment for. They're going to tell you average 6.5% rate of return, when in fact you actually made nothing in that account over that 2-year period. So again, that's a little bit of a tangent. All that to say, average rates of return are deceptive. You need to focus on account values, especially in retirement, especially when you're taking distributions. So again, sequence of returns risk is a huge risk that you have in retirement. Not a lot of people know about it. Well, what can we do to avoid or eliminate that risk of sequence of returns, right? And that's where the bucket plan philosophy comes into play. So this is the philosophy that we adhere to at Hammer Financial Group. We teach all of our clients about it. Every single one of our financial clients has their own bucket plan set up, okay? And it's really simple in nature. It's a 3-bucket approach, and ultimately what we're doing is we're placing assets for purpose, okay? There's a now bucket, a soon bucket, and a later bucket. The now bucket, that's really your emergency fund. That's your cash reserves. If you have any earmarked expenses over the next 12 months, that's where it's going to sit. It's generally in an FDIC insured bank account, checking, savings, or money market. You could also throw in short-term CDs into the now bucket as well. All that to say, no risk in terms of investment at all. Generally speaking, you're talking about your emergency fund. And I always say everybody has their own magic number that they like to keep in the now bucket. I have people that like to keep hundreds and hundreds of thousands in there. I have people that like to keep as little as possible in their now bucket. That's completely unique to you. Now the soon bucket, if we go back a couple of slides, that is the preservation stage of the money cycle, setting up a soon bucket. The idea with the soon bucket is we want 8 to 10 years worth of retirement income that we expect to need, right? That we expect that we're going to need to withdraw from these retirement accounts. We want to allocate 8 to 10 years worth of withdrawals in our soon bucket, and we want that invested differently. We want it invested more conservatively, more income oriented, so that when we do have market volatility, the accounts and the investments in our soon bucket are not affected nearly as much, right? We really don't want to take on that volatility, because this is the bucket of money that we're going to be looking to take withdrawals from for really the first 10 years of retirement, okay? And what that ultimately does, because now we know we have 10 years worth of income set aside in our soon bucket, invested more conservatively, more income oriented, what that allows us to do then is to allocate the rest of your retirement assets in the later bucket, which is more focused on long-term growth and legacy planning. And legacy planning could mean, leaving a legacy to children, but it could also mean leaving a legacy for a surviving spouse, right? Making sure the surviving spouse is taken care of in the case of a survivorship scenario. So really the later bucket then can hold the rest of those assets that you're not utilizing for income over the next 10 years. What you've done is you've bought yourself a 10-year time horizon so that we can take more risk. We can be a little bit more growth oriented. Now it's ultimately still based off of what your own risk tolerance is as to how growth oriented you would be in the later bucket, but you would be more comfortable taking on risk knowing that you have 10 years worth of retirement income set aside in your later bucket, so that you know if there is market volatility, if there's a correction, if there's a crash, you know that you won't have to touch the investments or liquidate any of the investments in your later bucket for at least 10 years. And historically, it's never taken longer from peak to trough back up to peak after a market correction to fully recover. So having that 10-year time horizon gives us a really, really, really nice cushion to know that, hey, if the market pulls back, if it corrects, I'm not going to have to liquidate any of my investments in my later bucket that experienced that volatility because I have the money set aside in my soon bucket. Gives the later bucket investments a chance to recover and ultimately avoids that sequence of returns risk that we talked about. Okay, so I know it's a simple concept, right? We're not reinventing the wheel, but it's extremely, extremely effective at minimizing that sequence of returns risk, which ultimately results from market volatility, especially in that retirement red zone that I mentioned, which is again 10 years prior and 10 years after retirement. That's that retirement red zone. That's where you have to be the most cautious and make sure you have your assets set up and structured properly to avoid something like what Mr. Johnson experienced in the previous example that I gave you. So again, I know I went on a little bit there in terms of our investment planning philosophy. It's what we use to minimize the volatility risk in the market for our financial clients, and it's what we use to avoid the sequence of returns risk so that we have a plan in place for everything that could potentially happen throughout our financial clients' retirement plan. So hopefully you gained a little bit of insight on how we do it and what you can potentially here apply in your own scenario in terms of the bucket plan concept. Thank you for listening.